on Social Security right now, or you are within 10 years of claiming, there is a very real chance you are leaving money on the table in 2026. And most people watching this have no idea because the Social Security Administration does not call to tell you. They do not send letters. They change the rules and they expect you to already know. Today I am going to walk you through exactly what is happening right now, group by birth year, so that by the end of this video, you know exactly what applies to you, what to check, and what to do about it before the window closes. Before I go any further, if you are not subscribed to Benefits USA, do that right now and turn on the bell notification. Here is why it genuinely matters. The SSA does not send you a personal explanation when the rules change. When they update claiming ages, Medicare premiums, or benefit calculations, they update the policy and move on. What this channel does is take those changes, break them down by what they actually mean for your specific situation, and get that to you before the deadlines pass and before the mistakes are already made. Hit subscribe. Let us get into it. The single biggest Social Security change of 2026 is a law called the Social Security Fairness Act. It was signed in January 2025, and it is the most important change to this program in decades. Here is what it did. For years, two rules called the Windfall Elimination Provision and the Government Pension Offset had been quietly cutting, and in some cases, completely erasing, Social Security benefits for millions of public sector retirees, teachers, firefighters, police officers, federal employees under the old retirement system, anyone who worked a government job where Social Security taxes were not taken from their paycheck. Those two rules are gone now, repealed, and the repeal is retroactive to January 2024, which means the Social Security Administration owes lump sum back payments to roughly 3 million people. Some of you watching already had a deposit hit your account in the last few months and did not know what it was for. That was your back pay. Some of you have a payment coming and have not received it yet. On top of the back pay, affected retirees are also owed a higher monthly benefit going forward, somewhere between $360 and over $1,000 more every single month, depending on your pension type. Here is exactly what to do this week. Log into your My Social Security account at ssa.gov. Look at your recent payment history. If there is a lump sum deposit somewhere in 2025 that you cannot explain, that was your Fairness Act back pay. If you do not see one and you ever held a public sector job that did not deduct Social Security taxes, call the SSA at 1-800-77-21213 and ask them specifically about the Fairness Act calculation. Do not just ask if your benefit is correct. Ask about the Fairness Act by name. That is the file they need to open. Group 1. If you were born between 1943 and 1954, you are between 71 and 82 years old. Your full retirement age was 66. You have been collecting for a while, and most people in this group assume there is nothing left to check. That assumption is costing some of you real money every single month. Check number 1. Are you on the right benefit? This matters most if you are widowed or divorced. If you lost a spouse, the SSA is supposed to compare your own retirement benefit against your survivor benefit and put you on the higher of the two. A survivor benefit can be up to 100% of what your late spouse was receiving. In a lot of cases, that number is significantly higher than what you are collecting on your own record. If you are divorced after a marriage that lasted 10 years or longer, you can claim on your ex-spouse's record up to 50% of their benefit, even if they have remarried, even if you have not spoken in years. The SSA does not automatically run these comparisons for you. Call them at 1-800-77-21213 and use these exact words. Compare both benefits, including the divorced spouse option if it applies, and put me on the higher one. For a lot of widowed and divorced retirees, that one phone call is worth hundreds of dollars a month for the rest of their lives. Check number 2, your Medicare premium. The standard Medicare Part B premium in 2026 is $285 per month. If you are paying significantly more than that, somewhere in the $300 to $500 range, you are being charged an IRMAA surcharge, and it is calculated based on your income from 2 years ago. If your income has dropped since then, because you fully retired, because a spouse passed away, because you had a one-time property sale, you can appeal that surcharge. The appeal form is the SSA 44, and it exists specifically for this situation. People pay the higher premium every single month for years without realizing they can fight it. One form filed correctly has put thousands of dollars back into people's pockets. Check number 3, the Fairness Act. If you ever worked a public sector job that did not deduct Social Security taxes, and you have not called the SSA about the Fairness Act since it passed, this week is the week to make that call. Group 2, born between 1955 and 1959. You are between 67 and 71 years old. This is the most consequential group in 2026 because the rules are different for every single birth year in this range, and most people do not know their specific number. Here is the full retirement age breakdown. Find yours. Born in 1955, your full retirement age is 66 years and 2 months. Born in 1956, 66 years and 4 months. Born in 1957, 66 years and 6 months. Born in 1958, 66 years and 8 months. Born in 1959, 66 years and 10 months. That is your number. Not 66, not 67, your specific month and year. Why this matters right now. People in this group are making, or have just made, their claiming decision. And the difference between getting it right and getting it wrong is permanent. If you claimed at 62 with a full retirement age of 66 and 6 months, meaning you were born in 1957, your monthly benefit was reduced by roughly 25.8%, and that reduction stays for the rest of your life. On a benefit of $2,000 per month, that is $516 less every single month forever. Over 20 years, that is more than $120,000 in lost income. The SSA does not warn you about that number before you file. They process the application. You sign. The smaller check becomes your permanent number. If you have not filed yet, every month you delay past your full retirement age earns you an additional 0.2% permanently. That compounds to roughly 8% more per year. Between your full retirement age and age 70, you can accumulate up to 32% more per month for life. On a $2,000 benefit, that is potentially $640 more every single month forever. The retroactive lump sum, almost nobody asks for this. If you apply for Social Security after you have already passed your full retirement age, you can ask the SSOA to backdate your claim by up to 6 months. They will pay you as if you filed up to half a year earlier in a single lump sum with your first check. On a $2,000 benefit, that is a check for up to $12,000 on day one. You have to specifically request it when you file. Nobody at the SSA will bring it up first. The earnings test, and if you are still working, if you are collecting Social Security before your full retirement age, and you are still working, the earnings test applies. In 2026, if you earn more than $23,400 in a year, the SSA withholds $1 of benefits for every $2 you earn over that limit. The money's not gone forever. It gets credited back once you reach full retirement age. But if you do not know this rule, that withheld amount feels like your check just disappeared without explanation. Group 3, born between 1960 and 1965. You are between 61 and 66 years old. For everyone in this group, full retirement age is exactly 67. And the most important thing right now is understanding what happens if you claim before that. Claiming at 62 with a full retirement age of 67 reduces your monthly benefit by 30% permanently. On a $2,000 monthly benefit, that is $600 less every single month for the rest of your life. Over a 20-year retirement, that is $144,000 in cumulative losses compared to waiting until 67. The SSA processes the early claim without warning you about that number. They ask if you understand your benefit will be reduced. You say yes. The smaller amount becomes your permanent number. The retroactive lump sum, also available to this group. If you apply after reaching your full retirement age of 67, you can request up to 6 months of retroactive payments. The SSA pays you as if you had filed up to 6 months earlier in a lump sum with your first check. On a $2,000 benefit, that is up to $12,000 handed to you on day one. Almost nobody asks for it. Check your earnings record now. For those in this group who are still 5 or 6 years away from filing, the single most valuable thing you can do this week is check your earnings record. Log into your My Social Security account at ssa.gov and open your Social Security statement. Compare the earnings listed for every year you have worked against your own records. One incorrect year, an employer who submitted the wrong amount, a freelance year that never got recorded, reduces your monthly benefit by approximately $100 per missed year for the rest of your life. Find the error now while you can still correct it. Group 4, born in 1966 or later. You are 60 years old or younger. You are not close to claiming yet, and that is exactly why this section matters more, not less. The window to fix certain things without it costing you money is still wide open, and it will not stay open forever. Your full retirement age is 67. Claiming at 62 means a 30% permanent reduction. Waiting until 70 means up to 24% more than your full benefit permanently. Those numbers are set. What is not set yet is whether your earnings record is accurate. The SSA has been recording your payroll data since your very first job. Every single year there was an opportunity for something to go wrong. A wrong number submitted, a year that got missed entirely, a period of self-employment that did not get reported correctly. Each uncorrected error reduces your eventual monthly benefit by roughly $100 per missed year. And that hit lasts the rest of your life. If you worked through the 1980s or 1990s during the era of manual payroll processing, there is a real chance your record has at least 1 year that does not reflect what you actually earned. W-2 forms, pay stubs, old tax returns. Those things get harder to find every year. Right now is the easiest moment in your life to fix this. Go to ssa.gov, log in and open your Social Security statement. Scroll down to the earnings record section. Compare every year listed against whatever records you have. If anything looks off, file a request for correction of earnings records with your supporting documents. The SSA updates your number permanently. Do it now while the paperwork still exists and while the fix is free. Now the section almost no other channel covers, and I promise you, it is the most important thing in this entire video. The federal government taxes your Social Security benefits. Not always, not for everyone, but for most retirees with any other meaningful source of income at all. And the thresholds that determine whether your Social Security gets taxed were written into law in 1983. They have never been adjusted for inflation, not once in over 40 years. Here is how it works. The IRS looks at what is called your provisional income. That is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits added together. Then they compare it to thresholds that have not moved since Ronald Reagan was president. If you are single and your provisional income is under $25,000 or married and under $32,000, none of your Social Security is taxed. If you are between $25,000 and $34,000 single or $32,000 to $44,000 married, up to 50% of your benefit becomes taxable. Above $34,000 single or $44,000 married, up to 85% of your Social Security check is taxable at your ordinary income rate. A married couple getting $2,500 a month from Social Security plus $4,000 from a pension and IRA withdrawals is sitting well above that $44,000 threshold. 85% of their Social Security, about $2,100 a month, becomes taxable at a 15% effective rate that is over $300 a month going right back to the IRS every month for the rest of their lives, out of a check they already earned. 4 legal moves to fight this one. Time your Roth conversions before you start collecting. Roth distributions do not count in your provisional income. If you spend the years between 60 and 67 converting traditional IRA money into Roth accounts, you lower your future provisional income permanently. 2. If you are over 70 and a half and you give to charity, use a qualified charitable distribution. A QCD goes directly from your IRA to the charity. It counts toward your required minimum distribution, but does not show up in your adjusted gross income. You can do up to $108,000 per year this way. 3. Be careful about realizing large capital gains in a year. You are also collecting Social Security. A big one-time gain pushes your provisional income up and can drag 85% of your Social Security into taxability for that year. Spread big gains across multiple years when you have flexibility. 4. Check your state. Most states do not tax Social Security at all anymore. If yours does, it is worth knowing. And for people with flexibility on where they live, a state move late in life can be worth thousands of dollars a year. Here is where I want to leave you. Every single thing on this list is yours to claim. The Fairness Act payment will not chase you down. The widow benefit comparison will not happen unless you ask. The IRMAA appeal will not file itself. The earnings record error will not be flagged for you. The provisional income calculation will not be optimized on your behalf. The entire system is built on the assumption that most people will not check. Knowing the rule and knowing it applies to you, that is the whole game. So do one thing before you close this video. Write down which group you are in and the one thing on that group's list that you have not done yet. Take 5 minutes this week, just 5 minutes, and do that one thing. Log in at ssa.gov, make the call, ask about the Fairness Act by name, file the SSA 44, pull your earnings record, just one, and then send this video to someone you know who is over 60, a parent, a sibling, a neighbor. Because every person watching this knows at least one other person sitting on money they are owed and have no idea it is there, simply because nobody told them what just changed. I will see you in the next one.